In this video, we're going to talk about how to do the accounting for held-to-maturity securities. So we have two broad types of securities. We have equity securities, which are things like stock, and then we have debt securities, which are things like bonds. So equity securities are grouped into either trading securities or available for sale securities. In debt securities, they can be trading securities or available for sale securities, just like equity securities. But we also have this third classification called held to maturity. So we can't have an equity security that's held to maturity because if you buy stock in Microsoft, there's no point where it's going to mature. However, with debt, for example, a bond, there's a point where the bond matures. So instead of classifying as trading or available for sale, in which case the bonds would be held on the balance sheet at fair value, you can have it as this held to maturity where you're going to have it on the balance sheet at what's called amortized cost. So we're going to talk about amortized cost, but before we do, to be able to get this treatment, to be able to do this held to maturity classification for debt securities, you have to have the intent and the ability in order to hold the securities to maturity. So, for example, if your company is about to go out of business and it's some 30-year bond that you have on your balance sheet and it looks like you're going to go out of business in the next couple of years, you don't have the ability to hold that bond for 30 years to wait until it matures. In that case, you would have to classify it as trading or available for sale. But if you have both the intent and the ability to hold the bond until it matures, then you can classify it as held to maturity at amortized cost. Now, to understand this amortized cost issue, let's walk through an example, make it a little bit easier for you to understand. So let's say you have a 3-year bond. So you have a 3-year bond, and this bond has a face value of $1 million. So the stated rate on that bond, the bond at which it's going to pay interest, is 9%. Okay, so that means $90,000. We're talking about annual, let's say here, it's an annual interest. Pays interest annually at 9%. So that's going to be $90,000 annual interest payment. And then the market rate is 7%. The market rate is what's used to compute the present value. And if you don't understand these concepts, I've got a video on valuing bonds, might make it a little easier. But I prepared an effective interest table, right? So we have an effective interest table here. And so this will help us understand this notion of amortized cost, right? So we start out the date that the bonds are issued, let's say January 1st, 2019. The bonds are going to be issued at a premium, right? And again, just a quick recap. So the market rate of interest is 7% when we issue the bonds, but our bonds actually pay interest of 9%. So because we're paying 2% higher than what the market rate is, our bonds are going to be issued at a premium. People will actually pay more than the face value of $1 million to get those bonds. So the premium, it comes out, the whole bond, what we get for the bonds is $1,052,486,000. Okay? And when we think about our journal entry, we're going to debit held to maturity securities. We're going to debit that for $1,052,486. And let's say we paid cash for this, so then we credit cash $1,052,486. Okay, and that's just what we start with. And so if we were to look at our balance sheet right after we bought these bonds, we'd see an asset of held to maturity securities of $1,052,486. So that includes that face value plus the $52,486 premium that we paid for these bonds. Okay, so so now the amortized cost is going to change over time, right? So we paid this extra $52,000 for $486, but that's going to be amortized, right? So we've got a certain amount of the bond premium is amortized each time we receive interest, right? So we have this interest revenue, right? And so the cash, this actually should be cash received here. So our cash received is going to be $90,000, the very first interest, the interest period. So we get $90,000, but our interest revenue that we would record is $73,674. So let's go about and let's think about this journal entry. So we debit cash for $90,000, and then we're going to credit interest revenue or interest income, $73,674. Now you see that our debits and credits don't balance, and so what do we do here? Well, we've got that amortization, right? We're amortizing some of that bond premium. How much is amortized? Well, the difference, right? We take the $90,000, the interest that we received, minus this interest revenue, okay, and that's going to give the bond premium that is amortized. That's $16,326. And so that's going to reduce our held-to-maturity securities on the balance sheet, right? So the HTM securities on the balance sheet are going to go down $16,326. So if we look, now we see that $1,052,486, we subtracted this $16,326, the amount of the premium that was amortized, and that equals $1,036,160, right? And so now on January 1st, 2020, if we were able to look at the balance sheet and see what's the carrying value of this held-to-maturity securities that we have, it would be $1,036,160. So the amortized cost changes each period as we amortize some of that bond premium. And just a quick review, if you're wondering how we would go about or where I came up with this $73,674 for interest revenue in the period, what I just did was I took the amortized cost of the bond, the $1,052,486, and I multiplied it by the market rate of interest is 7%, and so that gives us what our interest revenue is, $73,674. And then again, we just take the difference between that and this cash that we received, and that's the amount of the bond premium that we amortize. And then that bond premium that we amortize, we're just slowly taking it from the amortized cost, right? Each time we subtract that amount that we amortize. So in January 1st, 2020, we've got amortized cost of $1,036,160, but then we subtract the next period the amount of bond premium that we amortize that period, $17,469, and that gives us a new updated amortized cost of $1,018,691. And then in the final period, we amortize $18,691. So the final amount of the bond premium has been amortized. And so at the final day of the bond, when it matures, the amortized cost is $1 million.